Hey, hey, good morning traders and investors, and welcome back to our weekly live stream show. I'm your host, Bennett with TradingAnalysis.com. We appreciate you all taking time out of your Wednesday mornings to join us. We do apologize for getting started a little bit later than we typically do. Generally speaking, we're live about 8:45 Eastern. Had a couple of delays this morning, so we do apologize and appreciate you all sticking in here with us. Hey, we've got a good show in store for you this morning. As you can see, bottom left-hand corner of your screen. Index futures are down slightly. S&P coming off about a 0.4% decline. Same for the NASDAQ. NASDAQ's a little bit closer to a 0.5% decline that we saw overnight. We continue to track the volatility, taking it one wave at a time with our clients. Last week when we met, we discussed two possibilities in regards to the indexes. One possibility suggested that we were perhaps attempting the completion of at least 3 waves down from the January highs. I mentioned I was a bit skeptical, and we actually took that opportunity the Tuesday before our Wednesday live stream last week to take a short position in the S&P 500, looking for continuation to the downside. We did make a new low last Friday, at which point we started a fairly decent bounce back to the upside. We saw a retracement about 4.5%. That 4.5% retracement has given way to further downside. So we're going to get to the charts in just a few minutes. Before we get to the charts, let's go ahead and bring in the trading analysis team. And we've got a special guest coming up with you in just a couple of minutes. Good morning, Terry. Good morning, Alex. How are you gentlemen today?
Good morning, Bennett. Good afternoon, Alex.
Hey guys, good morning. How are you?
We're well. We're well. How are things in Serbia today?
Well, it's a nice weather. Summer is full blown, so everybody's on the street. So kind of an optimistic thing despite all of the stuff around. So
good.
Keep rolling.
That's right. That's right. It's tropical season here in Texas. I don't know if Terry's gotten much. I'm sure he's gotten some of it, but last night, man, it was just like constant downpour, a lot of thunder and lightning. Always, it's never a dull moment. There's never a dull moment here in Central Texas.
Yeah. What is important is it's volatile, so that's fine.
The weather's volatile and the markets are volatile.
Yeah.
I love it. All right, so hey, again, we've got a special guest coming up. I'm going to quickly take you through the indexes. Instead of going through the NASDAQ and the S&P and the Russell 2000, I'm going to focus today just on the S&P. We're going to kind of break it down and look at the two distinct possibilities in regards to where I see the wave count and where we could be going from here. So gentlemen, I'll be back on the other side. We'll bring in our special guest and we'll go from there. Sounds good?
Very good.
All right, catch you in just a couple of minutes. Hang tight. All right, good morning. Once again, let's hit it. Hard right edge of the Motive Wave platform. We're taking a look at price action in the S&P 500, going back to the upper left-hand corner of your screen where we met our January 4th, 2022 high, at which point we have been in a period of sideways to lower consolidation and correction. We've seen about a 20% correction here in the S&P 500. And as you can see, and as we looked at last week, there is a wave count which would suggest we are nearing the completion of 5 waves down from our late March high. Breaking this down from the January high, we can count our first motive decline into February 24th's low. From there, we retrace in 3 waves, at which point we moved into the April decision month, as we called it. And as you can see here, we have since given way to further downside in the markets. The equality projection in the S&P 500 was met at around 39.59. And as you can see here, in addition to that level also being our equality projection, said otherwise, the magnitude of the January 4th through February 24th decline projected from your late March high, that level did have confluence with our corrective trend channel. The corrective trend channel starts from the January 4th high over the late March high with your parallel trend line over the January 24th area lows. Now, moving into equality, you can see here, I'll take you off of the 195-minute time frame. We're going to go ahead and focus in on price action down on the 15-minute time frame. And what we're looking at is how markets have been interacting with not only that equality projection, but also that corrective trend channel, where we often will see corrections attempt to base and stage a reversal. So here you can see the decline that occurred into May 12th. May 12th's low near 3850 in the S&P did give way to a three-wave retracement. It was a fairly sizable rally. We had a fairly sharp initial actionary wave in a five-wave move up to the 14th or 13th. That was met with sideways consolidation and then a very lethargic, kind of meandering C-wave advance. This is where we took the opportunity to actually enter a short position, follow up short in the indexes with our clients, suggesting that the May 12th low did not, in fact, mark the end of the correction. Because technically speaking, you could have counted 5 waves into that low. The issue became the fact that markets retraced in 3 waves. Now here's an interesting tidbit that those of you who are perhaps more familiar with Elliott may appreciate. Looking at the highlighted price action here on the 15-minute time frame, you'll notice after the 3-wave retracement into May 18th, we were met with a 3-wave decline into last Friday. We had a big move down Wednesday, a little bit of a consolidation, a breather session, if you would, on Thursday, and that gave way to a secondary decline to make a new index low on May 20th, last Friday. Typically speaking, unless that 3-wave move occupies wave 5 of a higher degree ending diagonal, 3 waves cannot complete a motive trend. Therefore, I continue to view price action as, at the very least, still in a wave 5 ending contracting diagonal. Now this ending contracting diagonal may have completed its 4th wave into the high from the 23rd, as you can technically squeak out a 7-swing structure. There's an equal chance, I would say, that this orange 4th wave goes out a little bit further in time, and what we actually have is a move up in a big B wave decline into yesterday's retracement, and we're going to see continuation higher in C of wave 4. I'm open to either possibility. If in fact the market does start to move back to the upside, one key level that we need to be aware of is the equality projection of the orange circle wave 2. And you might be asking yourself, well, why is that important? Looking at the magnitude of orange wave 2, you'll notice here we first of all have a contracting, an overall contracting pattern, meaning orange wave 3 is shorter than orange wave 1. In an ending contracting diagonal, you need to see progressively smaller segments of the wave structure, which would mean wave 4 should be a smaller percent retracement than 2. That invalidation level is up at 40, 39, 25. But what's interesting is the way in which we've been interacting with this corrective trend channel, and it does look like it's ready to give way to further downside. Now, in regards to suggesting a larger X-wave retracement could be upon us, I still have my concerns regarding the validity of this 5-wave move. And what I mean by that is this. Looking at this structure, it's a bit unusual in regards to the guideline of the right look. We have a 3rd wave that's just longer than wave 1, and now our 5th wave is exceeding quite significantly its fib projections relative to 1 and 3. With that in mind, we have to be aware of the more bearish alternate that does exist in markets. The more bearish alternate would take us down to that 3,600 level, which is where our 1618 more significant projection sits. And that view would suggest that in fact we are either post wave 2, meaning we just completed a 5-wave decline from the late March highs. This is a larger wave 2 of C, and that could potentially take us down to the 1618 at 3591. This is why we feel it's very important to set yourself up with a team that can guide you through these market developments as they occur. It's been a very volatile overall trend, and as a result, there are multiple valid possibilities. So plan A, looking for a new index low. If that new index low does show signs of divergence that we would need to substantiate a reversal, I will, excuse me, be looking at, hitting my mic probably doesn't help. If we do see the new index low be met with the divergences we need and signs of a reversal with hopefully supporting extremes on the market internals, I will be looking at that as a completed 3-wave move to occupy either a wave 2 position of a higher degree ending diagonal fifth, which we've talked about many times on the show, or alternatively, this proves to be simply a W wave, we retrace in the X wave. And then at the same time, we can't discount the possibility that we're on an immediate path towards 3,600 in the markets, especially as we digest this corrective trend channel support, our equality projections. We just don't see the evidence to say that this is over. So we're going to take it one wave at a time. That's it for me. I took way too much time as it is. We've got a special guest. We've got founder of Trading Analysis, now co-founder and director of investments of New Age Wealth Advisors. Let's go ahead and jump to the Advisors Corner. Good morning, Todd. How are you today, sir?
Did you say Advisors corny?
I was halfway there.
You said special guest way too much, bro. I'm just checking in, saying hi, miss you guys.
We love your presence, man.
Yeah, all right. Thanks for having me.
Absolutely.
Good to see you guys. What's going on?
Same thing, man. Continuing to digest 2022 market volatility, guiding our clients through it one wave at a time. It's been an interesting ordeal, if you would. A lot of variables.
Like that, one wave at a time.
That's right.
Yeah, it's crazy. It's, I just jumping in. Just, hey guys, Todd. I'm lucky enough to set this company in motion 10 years ago. I got a great team running it now, keeping an eye on things and launching a wealth management business. Something I always wanted to do. And the idea is to have the two work side by side. And, as we're bringing clients on, that's how most of our clients are doing it. They're keeping a good percent of their own capital to trade and then kind of separating out that other bucket on the investment time frame. And that's super important in here. And it's the technical levels that Bennett was just mentioning. We're making portfolio moves. We're looking at multiple possibilities because that equality that Bennett just mentioned, I mean, there's so many different A = C percent distance change, support levels that are being tested. And if we break through, as Bennett said, that starts to suggest that it might be 1 and 2 down. You have wave 3, and that brings your 1.618 multiple down. So, there's a few different charts and even, within the FANG. I mean, I could show you some stuff. Apple's broken equality where Microsoft is still holding it. Tesla's still above it. Obviously not FANG, but we are making some moves. We have two main portfolios, one of which is growth and the other is tactical dividend. And we have raised cash, guys. We went up to about 14% cash. We actually got some short exposure in there with an inverse ETF. I'm not sure if I told you that, Bennett, but we are starting to hedge here a little bit in the event that we don't break to new lows. So this is sort of the basis for launching our wealth management business, sort of a continuation beyond trading analysis, active management. And, in this kind of market, you have to be actively managing and playing defense in here because if we move lower, I mean, Bennett, if we don't hold these equality levels, what did you say the downside target is again?
Yeah, so in the S&P 500, our 1618 of the January to February decline comes in at 3591. And we actually just had a comment from Andrew in the chat. Andrew was mentioning the slope of the C wave is a bit concerning. And in the S&P, I'm not as concerned as we essentially met time equality. But in regards to your point, Todd, about the possible 1-2 moving lower in a wave 3 position, in the NASDAQ, we actually met a quality of that initial decline at like 40% of time elapsed in wave A, and that, as you know, is more typical of an impulse move. So certainly a possibility.
Yeah, but okay, so throw the chart over if you don't mind. I'm just going to go over in a different out of order.
Yeah, let's see here. Let me go back to charts. 1 second. We'll bring your mic is live. Can you hear me now? There you are.
Yeah. Mm-hmm. So that's interesting. Certainly, the time elapsed because A was sort of this three-wave affair, and you could put A here or you could put A here, but it was shorter in duration, but you're starting to get momentum divergence, right? RSI has not made new lows, so the rate of change is decreasing as we're moving down and starting to test this big old zone of support. If you take a look at the SMH and specifically the NASDAQ, where are you guys putting the end of this wave in SMH? Is it Jan 27 or is it the new low on March 15?
Yeah, so in the SMH, I do have my A wave, so the initial decline into January. In that, the B wave does count well with the 1272 low into March, and that also explains the
difference in time.
5 wave. Yep, and that too as well. Absolutely.
Right. And Andrew brings up a really good point, and it does matter. Is the end of this would be a motive structure, whether it's motive to a 5-wave impulse or motive to a corrective ABC structure, that significantly shortens the time in allowing for that RSI divergence. And then, I've got the 2 fib support levels. So this is equality percent change distance traveled in green A versus green C here. And this other guy, this 100% is if we were down at March 17th. So, it's so interesting. You flip over to Apple, right? And if you look at, that's kind of funky. If you look at this decline here, we are clearly through A equals C, which was at 147. But SMH has held it. So it's very challenging. And basically what we've done, as I said, is we have brought in some short exposure in the growth portfolio. Certain clients who have individual cash accounts, we have put option structures on down around the 3,600 to take advantage of that if we do get down over the next 2 months. So we do have clients who are hedging on the downside, and we're kind of holding that. So it's a crazy market right now. And one thing that I kind of noticed, and I wanted to throw this by you, just kind of looking at data first, and then I'm going to get to the Fed. I don't want to take anything away from Alex, but housing data was pretty lousy yesterday. So we had new home sales come in significantly weaker. New home sales were down 16% month over month, and then for April, 591 and expectations of 750. So is that a sign that finally the housing market has been many new buyers coming to market? Who want to build? Is it signs of a recession? Is it exhaustion of demand? Is it higher rates? We don't know. Well, I think a lot of people are starting to say that, this is a sign of a coming recession. So we had durable goods also missed this morning, not good. We have GDP preliminary tomorrow, which is going to be interesting, and that would be the second quarter of contraction. So perhaps we're already in recession, and then pricing data coming up Friday. So that's going to be interesting with PCE, which is Fed's preferred inflation gauge. And then I didn't know if you guys have noticed this, but have you looked out in the Fed in terms of raising rates? 50 basis points is assured basically for June. 175 to 200 coming out of the 75 to 100 current. And then after we go, this is a small screen, 175 to 200, we have another 50 basis points in September. But actually, no, excuse me. Then we start to scale it back down. Actually, sorry. This is July. It's so small on the screen. So 175 to 200 in July. And then in September, we're at a 64% chance of 200 to 225, which is only a 25 basis point increase. And what you'll see is the odds have come off quite significantly over the last week. We were at 60, where were we? 54 for 225 to 500, and now we're at 30% just from 1 week earlier. So they're only looking for 2 more 50 basis points increase, and the odds have come off quite significantly in the last week to go only 25 basis points. So I don't know if a lot of people are talking about it. Have you guys picked up on that?
Sorry about that, Todd. We flipped to the wrong screen as you asked the question. Yeah, no, that is most certainly something we've been watching with clients. It has been interesting to see in the way in which markets have been absorbing the various data points that we've had this year, and with the June QT on the horizon, it's going to be interesting.
Yeah. So it was 54% a week ago to go. Another for a third 50 basis point increase. 1 day ago, it dropped down to 33.9%, and then right now it's down to 30%. So overnight, it dropped 4% to do another 50. So I think the Fed they're really starting to scale back the hawkishness that so many people have focused on, that I think is really pushing this lower. And then you guys mentioned it earlier. The staples have been absolutely hammered here. Last week, they were starting to throw out a lot of different sectors, and specifically industries that have been safe havens, that are very much consumer oriented. Home builders have been destroyed. Consumer staples have really come in quite a bit. And a few of them that we're seeing here, I can bring this over. You still sharing the screen, Bennett?
Yep, absolutely.
Okay. So this is just a daily RRG of the industries within consumer staples. And a couple of the guys that have been really coming off here are food retailers. You've got non-durable household goods, which talk about the most go-to safe haven. They're really sort of capitulating, I think, in these sectors and industries that have been safe havens, specifically with staples. We lightened up as on the last rebalance with consumer discretionary. We significantly reduced that. We're underweight consumer discretionary, and we're actually increasing, I think, the staples. We're increasing staples allocation even with this sort of last minute swoon. I think they just kind of took everything out and brought everything to the woodshed as we're still pushing these support levels. So I'm not convinced we're going to break that equality level that you're mentioning. Everything was kind of sold off. The tech crash has happened in the pandemic stay-at-home stocks. That tech crash, granted, with massive valuations already occurred. So now they're trying to take everything lower, which I think is good price discovery, and we're still above that support. So we're very much kind of taking it 1 day at a time. We are longer term in terms of our management, but we are allocating, getting defensive. And if we start to hold, we can very quickly start to move in the backside. On the upside, don't get too content on the short side for now. So it's interesting. The other thing I was going to say is we are going to do a webinar tonight. We're going to talk more about how we're positioning client portfolios, how certain tax strategies in certain trading accounts can kind of put you at a better advantage on how to be more strategic about that. Just talking about the volatility and how to handle it with your longer term portfolio. So it's going to be tonight at 8 o'clock. I'll drop a link here in the YouTube window, and you can go ahead and sign up for that. And that's right there if you go in the comments. So it'll be fun. Ryan and I, my partner, are doing it tonight. We are the co-founders of the wealth management business, and that's that. So guys, hope that was not a total waste of time. Thanks for having me, guys. Trade analysis team, you're doing wonderfully, and good luck out there.
Much appreciated. Thank you so much, Todd. And thanks for joining us again.
Yeah, my pleasure. See you guys soon.
All right. Take care. Have a good one.
Thank you, Todd.
See you guys.
All right. Terry, sir, we're going to pass the screen your direction. We'll get you set up. Markets, we've got about 1 minute to the open.
That's good.
You ready to hit it? All right. He's ready. Let's hit it. Hard right edge now into Optima.
Hello, traders. I'm Terry Long at tradinganalysis.com here with your weekly sector focus. So I'm sure you all know by now, the S&P has now closed at least 7 weeks in a row to the downside. There's the opening bell. Let me adjust something here real quick. I should have had that turned off. That just puts a little bit too much noise on the mouse there. Yeah, so these red rectangles are the weekly price action, obviously, and then inside there is the daily price action. But we've had 7 weeks in a row of declining performance in both the S&P and the NDX. And I think I don't have the Dow Jones plotted here, but I actually think the Dow Jones was down 8 weeks in a row. All right, I'm going to say that's only happened a few times in the history of the S&P. And I'm going to review that price action here in just a bit on some of those historic instances, and we'll see how the markets perform from that, and maybe we can glean something as to how our future is going to unravel here. But first, let's take a look at last week's price action here and sector performance. Now, last week saw the markets actually coming off of a bounce here, possibly with the prior Thursday having established a market bottom. That was, an optimistic perspective we had, but the bears overcame the short covering move and pushed the markets lower once again last week. For the week, the S&P closed down 3.05%. NDX was down 4.45%. Now, over here in the sector performance, look at this here. Once a bastion of stability, the staples sector closed lower by 3.05%. I'm sorry, this 8.1. I'm reading the wrong line there on my notes. 8.12%. That was a huge drop. That's making it the worst performing sector of the week. The consumer discretionary sector was also falling hard. Now, honestly, the staples sector, it was Walmart's poor earnings, and Walmart fell really hard. Walmart is a major component there of the staples, but it also dragged down Costco and several others, as Todd mentioned. In the consumer discretionary, we've got Target over there. So Target, similar to Walmart, but they're in two different sectors. Both of those had massive declines, and that's really what started driving down, as Todd was showing, the industry groups that were fading. Now, only the energy, the healthcare, and the utility sectors managed positive gains last week. I will give an honorable mention here to the materials sector. It did only see a slight 0.08% decline. All right, let's fast forward to this week's price action here. And as you can see, Monday started off kind of slow, but then accelerated throughout the day, closing higher both on the S&P and the NDX. S&P rose 1.86%. NDX was up 1.68%. But Tuesday saw these indexes heading lower in the morning and then begrudgingly retraced throughout the rest of the day. The S&P closed down just slightly, 0.68%. So we've got a net about a 1.03% for the 2 days in the S&P. But the NDX closed much lower yesterday. It was down 2.2%. So that's actually got us slightly in the negative for the week. Question will be, are we going to add another negative week here and be in a historic situation? Certainly, I think we're already historic by matching some very significant market extremes. I really think the market is begging for a bit of a bounce from here. So this week, staple sector is actually getting a nice bounce. It's up 3.5% off of that dramatic 8% drawdown last week. Energy, utilities, and financials are all up 2.5 to 3.5%. You can see here. And to the downside, though, we still have our technology and consumer discretionary sectors are the laggards for the week. All right, let's move over here. In our relative strength sector leader scoreboard, the energy sector still remains the relative strength leader. What we've been having here over the last couple of weeks is some some changing of direction of the final tail. It's been bouncing back and forth, positive to negative movement here. But the relative strength in the energy sector has not faded. Okay, so we only got a couple of days in the last vector there, so I don't really read a lot into the very last vector heading. More likely last Friday, because that gives me a full week on those vectors. We are seeing the utilities, staples, materials, healthcare, real estate, and industrials are still here in our lead, but we have been seeing some declining vectors there, especially in real estate. You know, Todd mentioned the housing market numbers month over month falling 16%. I didn't have my mic live right there and didn't want to interject, but I will say, I believe back in February and March, you go back and look and you'll see we had positive 11 and 12% month over month numbers during those months. And then so, you know, a 16% reversal, that's a huge signal, I think, to the market. So I'm really kind of nervous about what's happening here in real estate. I will say that inside the real estate sector, there are pockets of strength, but you've got to go dig for them. Okay. So down here, we finally seen in the lagging quadrant, the financials is turning blue. Okay. We saw the hook reversal a couple of weeks ago. Now we've got a blue vector. That blue means that the weekly price trend has now turned into an improving structure here in the financial sector. Technology, consumer discretionary, you can see consumer discretionary pushing further south. I do think it's kind of noteworthy here in the communication sector that we did push up here into the improving quadrant. And we've actually kind of stepped, in the last couple of weeks, we've stepped in a northeasterly heading. This week, that vector is kind of rolling over a little bit there. All right. I want to take you through real quick here what I see here. This is current price appreciation here in the S&P. Here's the COVID drawdown. It was about a 35 to 37, depending upon exactly how you measure the top and the bottom there. So that's approximate. We've already seen a 20% correction here in the S&P. But you know what? We did see a 118% rally from the COVID bottom all the way up until January 22 high. So do you think following a doubling that it was unexpected to have such a correction here? So what we've ended up with, and you can see these red candles here. This is a weekly price chart. 1, 2, 3, 4, 5, 6, 7 weeks down. This week is still holding out positive. We'll have to see where that goes. These little yellow arrows are my flags picking up on that. Now, the last time this happened was back in 2000. Let me see if I can get this screen to move over here. Come on now. May have to rescale it a bit. There we go. So coming off of the dot-com bubble, here's the last time that we had it. It was March 16th, 2001. Okay, so following the boom that we had in the 90s, all the way up until, again, the Fed started jacking the interest rates up once again. I don't have those numbers in front of me, but this is that point where the Fed started to off the economy by rapidly rising the Fed interest rate. So those rates came up, and then we started to see the corrective move. About a 25% corrective move occurred in the S&P up until, or at the point where we made those 7 weeks in a row down. Now, following those 7 weeks in a row, we did have a little bit of a bounce here, about a 13% bounce, but this was a pretty big bubble. So from there, we had another decline, ultimately taking it down another 30% before coming out here in March 2003. We can declare the end of this corrective move over, and then from there, we did have a big, huge rally. Ultimately, 47% decline from the dot-com bubble to the peak, and then we began another rally. Now, prior to this, let me go back again. Let's squeeze this out and take you back to 1980. Situation was different in 1980 too. Let's see if I can get this. There we go. All right. So here, back in March 28th of 1980, anybody old enough to remember what the interest rates were in 1980, 80, 81, 82? I believe mortgage rates were anywhere from 16 to 20%, somewhere during this time period. Inflation was on fire. Okay, so the inflation that we're seeing today, I don't believe is anything that matched that yet. So if inflation today starts to neutralize and calm, then maybe we don't have a repeat of this event, but who knows? I really think that the inflationary environment is the key here when you're looking at what happened in 1980 to compare to what's happening today. But anyway, we did see 7 weeks in a row right here of declining performance. And I'm sorry I'm keep dragging this around here. I'm just trying to get it to make sense to you. But here was the 7 weeks decline. Now, following that 7 weeks decline, there was not a subsequent low. That was the bottom. From that bottom, the market then over the course of the rest of the year, all the way through December of 1980, saw a 42% rally. From there, that point then looks to me like a bear market that declined about 26% here. And then following that bear market, there was another subsequent 65% rally here in the market. So one more to go back and take it. So, and if you guys remember back in the 70s, you remember something called stagflation? Okay, so back in the 70s, we had a period called stagflation. The S&P really wasn't going anywhere. And we had 7 weeks in a row right here, May 15th, 1970, that was the end of a 35% decline coming off of 1968 highs. Okay, now from that point there, the market then rallied 71%. Okay, but overall, the S&P did nothing over this decade, right? Okay, ultimately it was 108 in 1968, and it was 106 in 1978. So there's a whole decade where the market rolled up and down. Now, this didn't mean you couldn't make money, but you got to make money trading this environment and not investing in this. So that's all I've got, guys. I know we're short on time. Sorry I took so much, but I really thought it was important for you guys to take a look at those different time periods and think about the macro perspective that was happening at those times, how you think it compares to what today. And certainly it's different this time is true. Okay, don't you hear that and people try to dismiss that, but every time we have a correction, it's different. There are different factors at play, but you can use history to go back and try to analyze and get yourself some kind of thought process, market conviction as to how you think that's going to play out. So I'll hand it back to you, Bennett.
Thank you so much, Terry. Much appreciated as always. It is very interesting to go back in time and look at the various instances in which we have seen that continuous decline and what's followed. Some very neat tools within Optima that we will be exploring more with you all later this year. All right, Alex, we're going to pass. Alex, you're not in GoToWebinar,
yeah, he
sir.
is.
He is?
Yep.
Okay, I'll let you pass
Yeah,
over he's ready to go?
Did.
Oh, that's
Yeah,
why. You guys are you're too fast, too fast. All right, Alex, sir, you ready to hit it?
I beat you this time.
Love it. Team is on it.
I can't hear Alex, though.
I don't hear him either.
Can
Alex,
you hear me
are
now?
you self-muted?
There you are.
Yes, sir.
Yeah, my neighbor is doing some work, so I was cognizant enough to just mute because he was drilling something very heavy.
Okay.
Yeah.
All right, let's hit it. He's going to take you quickly through the macro scene. If you're interested in crypto, please tune in tomorrow morning, 9 a.m. Eastern. Same trading analysis YouTube channel for Crypto Lab with Alex. You ready to go, sir?
Yeah.
All right, take it away. We'll be back on the other side to wrap up.
Hey guys, let's look a little bit of a macro scene and just a couple of thoughts. I mean, we are dealing with a rate increase in this deflationary environment for almost, I don't know, 30, 40 years. Rates are around 1.5%. I mean, economy has been dealing with that also during the last economic era. So I think this is just basically adjustments between the maybe over-leveraged markets, and definitely I think, especially for the US, when the economy finds its balance, this drop is going to actually move according to, I think, our view that this is just a corrective process. I do really think so. I will show you a couple of charts. When I think, looking at them, we're going to have a pause in this interest rate increase, at least for half a year. That can manifest in a couple of months, but clearly, as I've been showing here for the last couple of weeks, we are seeing a great probability in that. So potentially, this X wave might be a possibility. I'm still not clear about that, but you will see in this couple of charts that I think the pause is going to come. Todd has already displayed this next Fed move, so 91.6% of a chance of the 50 basis hikes. Market has already priced it in, and even possibly a next couple of hikes. So I think really what is going to be important is, of course, press conference where the Jerome Powell will assess and actually give a transparent view how the Fed is going to proceed from this point. So let's move and see the rates chart, which hasn't changed much from the last week. So we do see a couple of more move on the upside. Still, we don't have an immediate invalidation levels reached here to believe that actually this cycle is done. From this perspective, I have been addressing this RSI, which is pretty high during this 40-year deflationary cycle on the downside, and from the lows, we are counting possible 5 waves up, which means that very soon I think we're going to have some type of a consolidation pause in this area, at least looking at technically. Every time we have reached this really high level in this raise in the rates, a couple of times in the recent history, we have backed down, and as you can see, we are backing down a little bit currently, but I do think since we cannot count 5 waves, clear 5 waves up, we're going to have a little bit more upside in the rates, and then possibly from July, August, we're going to, until the end of the year, come into a little bit of a sideways pause in these rates moving further on the upside. So let's wait and let's see that. Anyhow, I do see this, and I do agree with Bennett's wave count, which is showing our clients on the 10-year yields that this is most likely a finishing 5-wave pattern, and we're gonna enter into a consolidation. I do see that in many other charts, which I've been talking about last couple of weeks. In Europe, this is the German 10-year Bund, same thing. We are dropping from these key resistance levels. We still don't see 5 waves up. ECB is going to have its meeting soon. Lagarde has been vocal that they're going to start to move rates in September. We have seen the reaction on the dollar index moving lower, but we are still in the correction mode on that front, which I will address as well. So here only 3 waves up. This is a candidate, of course, since we have a prolonged move up on the 5th wave on the upside, but we still don't have a wave structure which actually gives us a viability to actually count this as a 5-wave move. Okay, so for now, this is still a 3-wave move. Backing out from the current resistance, we are going to wait for a full picture development, and then when we see a 5-wave move, we will be having a much more better and clearer orientation what will happen in Europe in the next year or in 2023. If we look the chart of dollar index, the correction I announced last week is undergoing. We do see this as a 4th wave pullback, some type of a correction, either sideways, either more directional, but we are still trading in this, I will say, a high-end range of this 104, 105 levels. So I still don't see any evidence that we are going to actually drop from here. significantly in dollar. I do see potentially just a little bit of a couple of weeks corrective process and then a continuation. I hope to a smaller target, because the larger target I have, which we usually use, calls for 109, 112 levels, which will be pretty high for dollar, very bad for the world economy because of the emerging markets. So I don't think, and I hope we're not gonna reach that. I'm looking for a one level lower, which will be around 107, 108, where we're gonna see this whole 5-wave sequence actually finish, and then world can ease off a little bit, because the pressure might be starting on the downside, at least back down to 90, 92, as we count this as a full 5-wave sequence. So looking at the Thomson Reuters CRB index, I've been addressing this chart a couple of times. I do see a 5th wave in development, maybe one more push up, which actually agrees with the 10-year yields. And when you overlay them, they go pretty nicely together. So I do also see a potential pause in the price of commodities on the upside. I think we're going to form either some type of a triangle or more directional correction. We will see that. But definitely I see this sequence actually completing itself very soon. And then we're going to fall down into a corrective process. Also, oil still keeping the touch with this consolidation. We are trading back and forth. Most likely, this are increasing the probability this is going to be some triangulation. We are still, of course, not sure, but when you have the trend on the upside and the range, and you have a consolidation like this, the probability is higher. We're going to continue in the current uptrend. And I look this cycle, which goes already after this large correction, we are going to look for a 5-wave move. And this is a call for pretty higher oil prices over the next couple of, I will say, year or two. On the upside, this wave count proposes a wave 1, wave 2. We are in the intermediary or a minor 5-wave move in an intermediary cycle, wave 3, and then we're going to see a pause if the things, of course, stays in this range and actually penetrate the upper level around 130, and actually we see a 3rd wave developments here. This is a pretty sharp uprise. It has some type of characteristics of a 3rd wave, which are usually pretty vertical. So we still need a little bit more of an evidence to actually confirm a break of this 130, 132 levels, and even going a little bit more higher. Net gas is developing as we were presenting here a couple of weeks ago. We are approaching the levels where we think the correction will start. Usually what we look from the projection from the wave 1 and 2 to get a target for the wave 3, of course, we need to see 5-wave move in the intermediary wave 3 or primary, however degree you want to call this sequence of the chart. We are approaching this 10, 15, 11 level. So I think clearly here you can see that there is a 5-wave pattern forming. So potentially we might see very soon some type of a consolidation or a bigger pullback in the net gas prices. According to this, RSI is also making a couple of divergences in this weekly chart, and that is what we usually look from the wave 3 and wave 5. And if you put this divergence, which works pretty nicely on the higher time frames, you will see that we have a higher high in the wave 3, and on the RSI now we have a lower high on the RSI and higher high on the price, which clearly indicates some discrepancy, which for us is a sign that these levels might actually work, and the correction in the wave 4, which will take a couple of months, might start very soon. If we look the total market cap in cryptos, just opening for the tomorrow crypto lab, our correction is still ongoing, so we do see this as a corrective process in a 4th wave. So we are tracking that for our members, which has been kept safe during all of this wreckage or wreck in the crypto markets. So we are ready to start and define our slow and beginning entries, of course, with a little bit of small capital exposure and then increasing as we see a confirmation. But we are coming to test very key levels. So if you want to see more about that, you can look the Crypto Lab with Alex tomorrow on the Trading Analysis YouTube channel. So let's review gold. Let's see what's going on with gold and silver. Gold actually held the necessary support, but we still don't see a 5-way move on the upside. We have traded a little bit below our preferred 78.6 level. This doesn't mean that we're going to see a reversal, because the move on the upside from this potential wave 2 has been a pretty lethargic. So I will not actually vouch for this development until I see a test in 5 waves of the previous swing high, which comes around close to 2000. We are trading at 1849. So this is, for me, it's not enough to confirm actually that the third wave on gold is starting. I'm still keeping the option that the gold is potentially is developing a wave 3 to the downside. Even if you take this as a flat or a WXY, it's really it doesn't change the things of the final target. Okay, so the final target goes between 1,600 and 1,672 for this potential wave 4. Depends how you can address from the Elliott Wave perspective these developments here. But anyhow, if we see a prolonged move down in gold, I think either in the ABC or a directional 5-way move, we are going to see these levels actually tested. And from there, we can see a 5-way move on the upside, which will confirm the continued trend. So this is clearly still in a corrective mode, sideways price action for already almost 2 years. And we haven't seen anything on gold which will for now give us the upside probability as an upper hand in the current developments. So silver still, I think, just moving around this pretty sizable 400 and more days supports. I've been talking about this in the last addressing. So I do think there is a little bit possibility of going further lower towards this 18, 19 levels. So I'm watching. I don't see 5 waves up for a confirmation of this end of this downtrend. So I will still looking lower, because this might be unfolding a 5-way move reaching this level. So I hope I didn't took so much time, guys. I see we are already close to the members webinar. So back to you, Ben.
We're out of time.
Very
Thanks,
good. Much
Alex.
appreciated. Absolutely. Excellent work as always. Yeah, did not mean to take away from your time. Apologize for getting started a bit late. And as mentioned, if you're interested in more of what Alex and, of course, the crypto markets are doing, please join us tomorrow morning, 9 a.m., right here on the Trading Analysis YouTube channel. Alex, Terry, appreciate it, gentlemen. Members, we'll see you in about 2 minutes for our member webinar. Markets are quiet to start the open. We'll see where we go from here. Any final words of wisdom?
Well, trade carefully.
That's right.
Yeah.
That's right. Manage your risk. Plan your trade and trade your plan. That's right.
Yeah,
all right, guys.
exactly.
Hey, viewers, we appreciate your time and thank you for joining us. If you did enjoy the content, please subscribe with notifications. Give it a thumbs up. Let the YouTube algorithm know to distribute it. We'll be back same time, same place next week, and we'll see you tomorrow morning for Crypto Lab. Have a good one, and we'll see you next week. Take care.